Alright everyone, welcome to a core component of the smart money concept, market structure and liquidity pools. Today, we're going to move beyond just what price is doing, and start understanding why it's doing it, and where it's likely to go next. Here's our roadmap. We're going to start by understanding what market structure is, and how to identify the key patterns of higher highs and higher lows, and their opposites. Then, we'll dive into the concept of liquidity pools, what they are, why institutions hunt for them, and finally, we'll bring it all together into a practical trading strategy. So, first things first, what is market structure? Simply put, it's the framework that defines the flow of price. It's the footprint of the market, made up of swing highs and swing lows. By reading this footprint, we can determine the trend's direction, spot potential reversals, and most importantly, find logical, high-probability areas to enter and exit our trades. Let's break down the building blocks. We have swing highs and swing lows. A swing high is a peak surrounded by lower highs on both its left and right. A swing low is a valley with higher lows on its left and right. From these points, we define the trend. A bullish structure is a series of higher highs and higher lows. A bearish structure is a series of lower highs and lower lows. So in a strong uptrend, you'll see price making consistent higher highs and higher lows. It's a staircase moving upward. Conversely, in a downtrend, it's a staircase moving down, with each rally falling short, creating a lower high, and each drop going deeper, creating a lower low. Now for the critical part, the market structure shift, or MSS. This is our earliest signal that a trend might be reversing. In an uptrend, the last level we watch is the most recent higher low. If price breaks below that HL, the bullish structure is broken. That's a structure shift. Similarly, in a downtrend, if price breaks above a previous lower high, that's a sign the bears are losing control. Okay, let's introduce the other key player, liquidity pools. This might sound complex, but it's a simple concept. Liquidity pools are areas in the market where a huge number of stop-loss orders are clustered. Think of them as pools of fuel that big players need to execute their large orders. Where do we find them? Typically above recent highs where sellers have their stops, and below recent lows where buyers have their stops. They mostly cluster at equal highs and lows or from highs and lows from previous hour, day, week, or session, and at key psychological levels. For example, round numbers are a key level that institutions target. This is where market psychology gets fascinating. Large institutions know where these retail stop-loss pools are. So, they often push the price into these zones to grab or sweep that liquidity, triggering all those stops. You'll see a sharp, often wick-like move into the pool. But here's the key: after the liquidity is swept, price often reverses sharply and moves in the intended direction of the smart money. This is what we call a stop hunt or liquidity grab. So, how do we trade this? We combine the two concepts. This is the powerful part. First, identify the current market structure. Is it bullish or bearish? Second, locate the nearest significant liquidity pool. In an uptrend, that's often above a previous high. Then, we wait for the play to unfold. We watch for price to sweep that liquidity pool. And then, crucially, we wait for a market structure shift against the old trend. That's our confirmation to enter in the new direction. Let's make it concrete with an example. Imagine price is in an uptrend, making higher highs and higher lows. It then rallies up and sweeps the liquidity above a previous high, triggering all the bullish stops. But instead of continuing up, it reverses hard and breaks below the last higher low. That break of structure, that MSS, following a liquidity sweep, is a very strong signal that the trend has reversed, and we can look for a short entry. To wrap it all up, your key takeaways are this: market structure defines your bias and the trend. Liquidity pools show you where the market is likely to be drawn to before making its next major move. By combining these two ideas, you're no longer just following price, you're anticipating its moves by thinking like the institutions that drive the market. This is the foundation of trading with smart money, and it will dramatically improve the precision and timing of your trades. That's all for this lesson.